consisting of 3 questions from IND AS 115 from CA Final Financial Reporting, which I found really interesting. The first question is on disclosures, the second one is on service concession agreements, and the third one is on discount coupons. So going through the first question, that is from November 2019, I'll just read out the question and explain the gist here. So the question says that N Limited has entered into 2 contracts. First one being with A Limited, the second one be with B Limited. The first contract has, first thing, the total revenue is 40 lakhs. The total cost initially estimated was 32 lakhs, but it was revised 34 lakhs. So you would be using 34 lakhs as our cost estimate. The third point being they have percentage of completion given as 30%. The question further states that the revenue is recognized over a period of time. So 30% is output method. Then it states that the cost incurred till date is 16 lakh and you have received payments of 13 lakh. So we would be doing is first making the extract of the profit or loss. The profit and loss would look like this. The revenue recognized is 30% of 40 lakhs. The cost of contract being 34 lakhs times 30%, that is 10.2 lakhs. You would not be recognizing the actual cost incurred, because you can think of it like inventory, the cost of goods sold. We have only sold up to the revenue of this. We would only be recognizing the cost incurred till this. We have not sold or not billed the revenue of the following items. We would not be recognizing the cost of this item. This is according to the matching principle. So very deeply engraved under 115 is the matching principle also. So then you will be recognizing what is called contract liability. The contract liability would be recognized as you would be debiting the customer by your billed revenue and you would be deducting the receipts from it. Very simple accounting. You would be left with a negative figure that would be shown as contract liability as advances from customer. You have not serviced these receipts, so these are your advances. You will not be netting these from the contract asset. These are shown under current liabilities or non-current liabilities if you are if these are long-term advances. That would be the case as well. Contract assets. You have expensed cost of 16 lakh, but you have only recognized cost of 10.2 lakh during the year. So your contract asset, that is something like a work in progress, is 5.8 lakhs for the contract one. This would be shown under the current assets as contract asset work in progress. You can think of it as inventory, just like you have purchased some inventory and you have expensed the cost of goods sold. What you would be left with is your closing inventory, which would consist of as well, consist of work in progress as well. Similarly, they talk about the question, the part 2 of the question, which is not really a big deal. That's again a simple contract of 30 lakhs with total cost estimate of 24 lakhs with total payments received 9.5 lakhs and total cost incurred being 8 lakhs. And lastly, it says the 20% percentage of completion has been estimated by the surveyor. So, and the question states the following, that there are several contracts. You can ignore these while preparing the financial statements of the company. So what you would have to do is just give the extracts. So these are few points that you can keep in mind when doing such disclosure question. The first one is think of it as matching principle. Think of contract asset as something like inventory. Think of contract liabilities as just simple accounting entries, and that's it. Concept of service concession agreements. So this is given in the appendix of 115 and not in the standard itself. And from where it is adopted? It is adopted from the IFRS, that is the Interpretation Committee's guidelines or something that is under the IFRS regime, which I also studied during my ACCA, but not the IFRS because they were out of the course of the ACCA final exams, that is SBR, Strategic Business Reporting. So let us go through the question, then I'll give some bird's eye view of the service concession agreements and the topic discussed. So the question says that the entity A has 2 projects going on. The first one is Bhilwara-Jabalpur toll project and the second one is Kolhapur-Nagpur expressway. So the Bhilwara-Jabalpur toll project, as they have incurred cost of 50 crores during the year. They expect the total cost to be 100 crores. The fair value of the construction services 110 crores, while they expect the government to provide them cash flows of 200 crores. They expect the government to provide them 15 crores of finance cash flows. during their operation phase, and the remaining net income, which is of course after the financing cash flows, is 185. That would be related to their other services during the operating phase. These all would be provided by the grantor, that is the government. So in service concession agreements, there are two types of parties. The first one is the operator, the second one is the grantor. So if the operator creates an asset or constructs an asset or improves an asset, something like a public toll, road toll or public toll, whichever is a public facility, then the government may allow the operator either a right to receive payments from the grantor, that is the government, or a right to charge the public for their services. So a bird's eye view of the service concession agreements would look like this. Let me check if this is clear. Yes. So the service concession agreement, if it consists of asset either being constructed or upgraded, not being maintained, if there is a question of maintenance in the service concession agreement, it would not be considered under this criteria of upgradation or construction. So if the operator has a right to receive payment from the grantor, then we can recognize a financial asset. The first question would be at what value? It should always be at fair value, because financial assets are governed by IND AS 109, which always says you should recognize it at fair value. To what extent? You would be recognizing to the amount which is recoverable from the grantor. Why is that so? Because you would be taking into account the IND AS 136 as well. That says you cannot recognize something above its recoverable amount. All right. The second point being, if the operator has a right to charge the public. If I have the right to charge the public, it would give me a license or something like an intangible. So you would be recognizing an intangible asset, which is again recognized at fair value, because to be consistent with the contract part, the financial asset part, that is all. Otherwise you would be doing is you should have recognized it at cost, but this is at fair value of the intangible asset. All right. To what extent? To the extent that is recoverable in the future. So again, IND AS 36 comes into play. So to solve these kinds of question, what we would be doing for Bhilwara question, first of all, what you would be doing is writing out all the details, that is total expenses incurred, estimated total cost, fair value of construction, guaranteed cash flows, financing cash flows, and operating revenue being the 200 minus 110 minus 15. So you would be receiving some other operating revenue from the grantor itself. So the entries will go as follows. First, you will be incurring some cost of construction during the year, that is 100 crores. So you would be debiting the cost of construction, creating the bank account. Then you would be recognizing the revenue and the financial asset. The financial asset debited at fair value of the cost of construction, credit the revenue from cost of construction for the construction services provided to the government. Then you would be debiting a financial asset to the revenue for financing cash flows received from the government. And then you will be debiting a financial asset and creating the revenue again by 75 crores for operating revenue received during the operating phase. And lastly, when you will receive the receipts, what you would do is bank debit, created financial asset, and you would see the trial balance as financial asset would be eliminated, and revenue of 200 crores would be recognized from the guaranteed cash flows, and you would only receive 100 crores. Why? In the bank, because you would have spent 100 crores on cost actually, and you would get profits of 100 crores in your profit or loss. So your trial would be balanced. The second part of the question is based on Kolhapur. Kolhapur-Nagpur Expressway, the gist of this part is the said project will be at 110 crores. The cost of construction is 110 crores. The fair value of construction is 200 crores. Okay. And you would have the right to charge the customers. Okay. You would have the right to charge the users of the expressway. So in this case, what we would be doing is going through this part. It has the right to charge the public. We would be recognizing intangible asset at fair value. So we would be recognizing an intangible at fair value, creating the revenue. That's very strange. You would be debiting intangible, creating revenue. But remember, the IND AS 115 also allows commercial substance transactions by barter to recognize revenue as well. That's why you can recognize revenue and recognize an asset simultaneously. So this was question number 2. A very sweet, small question, but one which can throw you under the bus when it comes in exams. RTP of CA final, if I'm not wrong. This is from RTP. So the question goes like this. KK Limited runs a departmental store which awards 10 points on purchase of every 500 rupees. So if you're purchasing for 500 rupees, you would be awarded 10 points. and each point is redeemable within 3 years from the purchase date. Okay, and value of each point is 0.5. So you would be writing these details in your initial analysis of the discount points. So the ratio of points and revenue for 500 rupees of revenue, you will be getting 10 points. The ratio is 1:50, and value of each point is 0.5 per point. All right. So next part of the question says that during the period 17-18, the entity awarded 1 crore points to various customers, of which 18 lakh points remained undiscounted to be redeemed till 31st March 2020. So within the 3 years period, the management expects only 80% of the remaining will be discounted in future. So these pointers which are stated here, such as the 80% remaining, these relate to only the part 2 of the question, which is wrong in my opinion. The breakage, that is the expectance of 20% being not excised, should have been recognized initially. If it is highly probable, let's say, if it is not highly probable, there is only 80% probability that, but what is the confidence of the management, that would also differ. So in my opinion, this is a vague area, but we'll follow whatever ICI says in this question. So the first part of the question is, how should the recognition of sale of goods worth 10 lakhs on a particular day should be done? I have written down the questions here as well. So instead of going back to the question, we would be using this part. All right. So the first part is recognition of sales of 10 lakh on a particular day. So we have two performance obligations. We are providing two distinct benefits to the customer. The first one being sale of goods, and the second one being discount in the future. So the fair value of sale of goods is 10 lakhs. That is clear. But this fair value of the discount in future is 10 lakhs into the ratio into value of each point. That is 10 lakhs into 1/50 into 0.5, which is 10,000. Okay. So that gives us the total standalone selling price of the performance obligation is 10 lakh 10. And the transaction price is 10 lakhs. You would be only charging the customer 10 lakhs. All right. So allocation on standalone selling price basis is 1:100. That is sale of goods is this. The formula I should have written here. That is this. I've used round just to get rid of any decimal places, and discount in future as well. That would be the residual value, or just 1 above 101 into 10 lakhs. And the accounting entry would be like this. This is fairly simple. This is the usual way in which two performance obligations or multiple performance obligations are allocated transaction price and recognition of revenue as well. Because the revenue is recognized at the point of sale, and the discount revenue, that is the discount in future, is a performance obligation that would be recognized in the future when either the customer takes the benefit or lapses the option. So we would be recognizing a liability on this date. That is as follows: loyalty program liability, which is of course a loyalty program. We can give any name to this, doesn't matter. The question number 2 and 3 say that if the total sales during the first year are 5,000 lakhs, which is 50 crores, what is the entry? Entry would be the same. If you have recognized 10 lakhs, you would be just multiplying it by whatever 500. Okay, so the same first part of the question would be same. What I have done is just multiply it by 500, sorry. It's the same entry. All right. But the second part of the question, that is, if the following conditions exist, that is, during the year you would have granted a 1 crore points. The points remaining at the end of the period are 18 lakhs. The entity expects 80% of the points to be excised during the period, during the next period or the future periods, and it expects the 20% of points to be lapsed during the period. What would be the closing liability? So the closing liability in the first period would be based on the future vesting that is expected to vest, not on the expected lapses. So first of all, we'll do this analysis, the excise of discount. So points excised during the year would be 82 lakhs, as 1 crore points were granted and remaining are 18 lakhs at the end of the period. So 82 lakh points have already been excised. The remaining points to be excised in future, expected to be excised in future, are 14.4, which is 80% of your 18 lakhs. Okay. The total points to be excised during the whole life of the contracts is 96 lakh 40,000. All right. So you would be recognizing the liability recognized, that is 49 lakhs 50,000 here, is equivalent to 96 lakhs 40,000 of points. The outstanding number of points at the year end was 14.4 lakhs. So you would be recognizing the proportional liability at the end of the period. That would be corresponding liability is 7.39, which is nothing but 14.4 lakhs divided by the 96.4 lakhs times 49.5 lakhs. All right. And I have rounded just to get rid of decimals. And the liability to be written off to revenue, because if the points are excised, you have performed the performance obligation and therefore you would be recognizing the revenue. And therefore the loyalty program liability would be debited by such amount 42 lakhs and you'll be crediting the revenue in that period itself. Okay. The mistake that one could make is not taking into account the expected unused outstanding points. I will just zoom it out for clarity. Not taking into account the expected unused for outstanding points. That would be one of the mistakes. You should always use whatever is expected in the future. Similar to 102, where share-based payments, you would be estimating the number of options that would be lapsing at the end of the period. You would not be taking into account while estimating your expenses. Similarly would be with this liability part. Now, question number 4, part 4 of the question says that if 60% of outstanding, that is 18 lakhs, this is a tricky part. They say 60% of the outstanding expected to be realized are 14.4 lakhs, but the actual outstanding points are 18 lakhs. Okay. In the next year, 60% are excised. What would be the entry? Very simple. What you would be doing is, we expect the future points to be excised and the liability recognized is corresponding to 14.4 lakhs, out of which 10.8 lakh, that is 60% of 18 lakhs has been excised. So you would be recognizing the expenses of 10.8 lakhs out of the 14.4 lakhs times whatever the liability was recognized, that is 7.39 lakhs. All right. So this is a fairly simple performa that would be used. You would not be adding this back because the points expected to be redeemed total 14.4 lakhs, not 18 lakhs. Right. If the estimate was revised here, then you would be taken into account. Otherwise, you would not be, because this is an accounting estimate which would be accounted for prospectively, not retrospectively. Okay. So same formula, that is corresponding outstanding liability would be 3.6 lakh. That is the outstanding points at the year end 2, and times whatever your previous liability was, 7.39 lakhs divided by 14.4 lakhs, the proportional liability of the points. And lastly, liability to be written off is the difference between the two, or just 10.8 lakhs. 10.8 lakhs divided by 14.4 lakhs times the previous liability 7.39 lakhs. And you would be doing this entry similarly of loyalty program liability, recognizing the revenue of 10.8 lakh points redeemed. Very simple. The last part of the question is, in the last year, the third year of the program, 3 lakh points were redeemed. What would be the treatment? So this is a curveball. Why is that so? Because if you think from the point of share-based payments, let's say, it's just a view that the accounting criteria is somewhat similar. You'd be expecting such so and so points to be redeemed, so and so options to be vested. The similar thinking could be applied here. In the last year, what you would be doing is just clearing out all your provision and provision for share-based payments and emptying it into your retained earnings. The same would be for these point liabilities or this revenue program liabilities. You would be just charging it to revenue, whatever is left, because even if it is not excised, you will be throwing back the liability into your revenue. And if it's excised, then still you are going to charge it to revenue. In both cases, it is charged to revenue. So in this case, no need for analysis of last year figures and anything. You just have to transfer the outstanding liability into your revenue. So fairly simple question, but there could be many mistakes made in the calculation parts. So I hope you found this small discussion of three different questions from 115 very useful, and we'll catch up next time.